All right, so let's talk about growing that money you've worked so hard for. You know we're going to dive deep today into CDs, certificates of deposit. Now, I'm sure you've heard of CDs,
Of course.
but are you really squeezing every bit of potential out of them? Probably not.
Most people aren't.
That's why we're here, to help you out. I mean, there's a ton of information out there, especially online, like on sites like The Balance. That's actually what we'll be using today as our main source. But honestly, who has time to read through all of that?
Yeah, it's a lot.
That's what this deep dive is for, right?
Exactly.
Okay, so real quick, what exactly is a CD?
Yeah, good question.
Essentially, it's a time deposit.
Right.
You commit your money for a set period of time at a guaranteed interest rate. Sounds pretty simple, right?
On the surface, yeah.
But the details,
Yeah.
that's where it gets interesting.
For sure.
We're talking terms ranging from just 3 months all the way up to 10 years. And each term comes with different rates.
Oh, yeah, a huge range.
And when I say varying, I mean some of these APYs are seriously impressive. Like, have you seen Ponce Bank Direct's 3-month CD?
No, I haven't. What's that at?
It's sitting at 5.10% ATY.
Whoa.
That's some serious short-term growth potential.
Definitely is.
That's just one example. Today, we're going to break down all the best CD rates from the Balance's November 2024 report. They've done a lot of the hard work for us already. They analyzed over 150 banks and credit unions.
Wow, that's a lot.
Yeah, it's really helpful. You know what I really appreciate about the Balance's methodology?
What's that?
They don't just blindly chase the highest APY.
Yeah, that can be misleading.
Right. They really dig into the details that can trip people up, like minimum deposit requirements and early withdrawal penalties.
Oh, yeah, those are so important.
It's about finding those CDs that offer the best overall value, not just a flashy rate that might come with hidden downsides.
Exactly. You got to look at the whole picture.
It's easy to get caught up in just chasing the highest APY.
Oh, yeah, I've been there.
Right.
Definitely.
Okay, so let's break this down by term length, starting with those 3-month CDs. Like I mentioned earlier, Ponce Bank Direct really caught my eye with that 5.10% APY. Is that typical for a short-term CD?
I'd say that's actually very competitive for a 3-month term. It seems like institutions are really trying to attract those who might be hesitant to lock in their funds for longer, especially with all the uncertainty in the current economic climate.
Yeah, that makes sense. We'll definitely have to dive into the economic climate a bit more later. But first, let's keep going through the other terms. For 6-month CDs, it looks like New Vision Federal Credit Union is at the top, with a 5.50% APY. And then for the 1-year CDs, Apple Federal Credit Union comes in at 5.00% APY. So it seems like the longer you commit, the higher the potential return.
Yeah, that's the general trend.
Which makes sense. But when would someone actually choose a shorter-term CD over a longer one?
Well, it all really comes down to your individual financial goals and your risk tolerance. Like, say you have a short-term savings goal. Maybe a down payment on a car in 6 months. That 6-month CD from New Vision could be a great fit. You get a much better return than a regular savings account, and your funds are available when you need them. On the other hand, if you're looking for a more long-term, set it and forget it kind of investment, then a longer-term CD might be more appealing.
So it's about matching the CD term to your specific needs and timeline.
Exactly.
Okay, that makes sense. Now I'm curious about some of these institutions themselves, like New Vision Federal Credit Union. It was originally for Douglas Aircraft employees, but now anyone can join.
Yeah, they've expanded their membership criteria over the years. Actually, a lot of credit unions have open membership requirements.
Yeah.
It's worth checking out if you're looking for those competitive rates and a more community-focused banking experience.
Oh, that's good to know. And then there's Apple Federal Credit Union. They stand out because of their nationwide reach through shared branching. So even though they're based in Virginia, I could access my account anywhere in the U.S.
Yeah. Exactly. Shared branching lets you do transactions at other participating credit unions, just like you were at your own. It's a huge perk for people who travel a lot or have moved. It really speaks to the collaborative nature of the credit union system.
That's really cool.
Yeah.
Okay, one more institution that I wanted to mention, Dow Credit Union. I wouldn't think they'd be open to just anyone, but they actually have a pretty diverse list of eligible employers.
It's not just about working for Dow Chemical anymore. They partner with a lot of different organizations and businesses. So their membership is much more accessible than you might think.
So you might have to do some digging to see if you qualify. But this all brings up a bigger point. If we're thinking about locking away our money in a CD for, say, 5 or 10 years, are there other factors besides APY and accessibility that we should consider?
Absolutely.
Like what?
You're right to be thinking about the long-term implications. It's not just about today's rates. It's about the overall financial health and stability of the institution.
That's a really good point.
We'll talk more about that in a bit. But before we go there, I want to circle back to something you mentioned earlier. Choosing the right CD term based on your goals. You hit the nail on the head when you said it's about matching that term to your specific needs. CDs offer higher rates than traditional savings accounts. But remember, your funds are locked in for that term. This isn't a break in case of emergency kind of investment.
Right, because early withdrawal comes with a penalty, which is definitely something to keep in mind. This makes choosing the right term even more important. It sounds like a bit of a balancing act, especially if you want to maximize your return but also maintain some flexibility with your funds.
Exactly. And that's where a strategy like CD laddering can come into play. It's a way to stagger your CD maturities, so you have access to a portion of your funds at regular intervals, while still taking advantage of those potentially higher long-term rates.
Okay, CD laddering. That's come up a few times now. And I have to admit, I'm intrigued, but I'm a little fuzzy on the details. Can you break that down for me? And for our listeners who might be wondering the same thing.
Of course. So imagine you have $10,000. You're ready to put into CDs. Instead of putting it all into, say, a 5-year CD, you could divide it up. You could put $2,000 each into a 1-year, 2-year, 3-year, 4-year, and 5-year CD. That's your ladder. Now, each year, one of your CDs matures. You can then take that money, reinvest it into a new long-term CD, or use it for something else entirely.
So each year, you have a chunk of money becoming available, which gives you options. That's a really interesting approach. I can see how that would be appealing for someone who wants to play it a little safer, but still get those higher returns.
Exactly. It helps mitigate risk while keeping your money working for you. And it's a strategy that can adapt as interest rates change. Let's say rates go up in a couple of years. When one of your shorter-term CDs matures, you can then reinvest that money at the new higher rate.
Oh, okay. That makes a lot of sense. It's like building in some flexibility without sacrificing potential growth. Now, what about those no penalty CDs we mentioned earlier? It sounds almost too good to be true. Is there a catch?
Well, there is a trade-off. No penalty CDs typically offer a slightly lower interest rate compared to traditional CDs. But the advantage is that you have the freedom to withdraw your funds without incurring a penalty if an unexpected need arises. It's about finding that balance between return and accessibility.
Right. It's all about weighing the pros and cons based on your personal circumstances. So we've covered CD basics, different terms, some of the standout institutions from the balances report, and even strategies like laddering. But I'm also thinking about what the balance might not be telling us explicitly. What are some other factors that might not be obvious at first glance, but are super important when choosing a CD?
That's a fantastic question. One thing that immediately comes to mind is the overall financial health and stability of the institution offering the CD. This is especially crucial if you're considering a long-term CD, where your money will be tied up for several years.
Okay, so it's not just about finding the highest rate. We need to be thinking about the bigger picture. So what are some signs that an institution might not be as stable as it appears?
There are a few things you can look for. Check their financial ratings from agencies like Moody's or Standard & Poor's. These ratings give you insight into an institution's creditworthiness and stability. You can also do some research into their history. Have they had any recent regulatory issues or financial troubles? And don't overlook customer reviews. They can often reveal insights into an institution's customer service and overall reputation.
So it's a bit like due diligence, almost like you're investigating before making an investment.
Right.
Which makes sense. We're talking about our hard-earned money here. And speaking of due diligence, is there anything else we should be considering?
Absolutely. Another factor that often gets overlooked is the quality of the institution's online banking platform and customer service. You'll be interacting with them for the duration of your CD term. So it's important to feel comfortable and confident in their services.
That's a really good point. I know I've gotten frustrated with clunky online banking systems in the past, and if I'm locking my money away for 5 or 10 years, I want to know I can easily access my account information and get help if I need it. Are there any red flags we should be looking for when it comes to online banking and customer service?
Definitely. Pay attention to things like website security, user-friendliness of the platform, and the availability of customer support. Look for reviews that mention response time's helpfulness and the overall ease of interacting with the institution.
Okay, so we're really building a comprehensive checklist here. We've got the APY, the term length, the institution's stability, their online banking platform, and their customer service. But we're missing one crucial piece of the puzzle, aren't we?
You're right. We can't talk about investing without considering the broader economic environment. inflation, interest rate trends. These all play a huge role in the real return you'll see on your CD.
You're absolutely right. It's like we've been looking at all the individual pieces of the CD puzzle, but haven't stepped back to see the whole picture. So how does the current economic climate, especially inflation and interest rates, factor into choosing a CD?
That's where things get really interesting. Inflation can be a silent killer of returns. Let's say you lock into a 5-year CD with a 4% APY. Sounds great, right?
Yeah.
But what if inflation averages 3% over those 5 years? Your real return, after accounting for the decreased purchasing power of your money, is only 1%.
Wow. That's a really sobering thought. It's a reminder that those headline APY numbers don't tell the whole story. So how can we factor in inflation when making CD decisions?
It's all about being strategic. If you expect inflation to remain high, you might consider shorter-term CDs, so you can reinvest at potentially higher rates as they become available. Or you could explore inflation-protected CDs, which adjust their interest rate based on inflation.
Inflation-protected CDs? That sounds intriguing. Is there a downside to those?
They typically offer a lower base interest rate compared to traditional CDs. It's a trade-off. The potential for higher returns if inflation rises, but possibly lower returns if inflation stays low.
Okay, so it's another decision point where we have to weigh our options and risk tolerance. And what about interest rate trends? How do those play into the equation?
Interest rates and CD rates are closely linked. When the Federal Reserve raises interest rates, CD rates tend to follow suit. If you believe interest rates are heading upwards, you might opt for shorter-term CDs. So you can take advantage of those higher rates when your CDs mature.
So timing is everything, especially in a volatile interest rate environment. It makes those short-term high-yield CDs like the 3-month one from Ponce Bank Direct even more appealing. But then again, maybe you think interest rates have peaked and you want to lock in a good rate for the long haul with a longer-term CD. It's almost like trying to predict the future.
Exactly. There's no crystal ball. But staying informed about economic forecasts and trends can help you make more informed decisions.
So it sounds like choosing the best CD is a very personal decision. There's no one-size-fits-all answer. It all boils down to your individual financial goals, your risk tolerance, and your outlook on the economy.
I couldn't have said it better myself.
Yeah.
It's all about finding the right fit for your unique circumstances.
And this is where a resource like The Balance can be so helpful. It provides a great starting point with those curated CD rates. But as we've discussed, there's so much more to consider beyond just the numbers.
Absolutely.
This deep dive has hopefully given you the knowledge and tools to dig deeper, ask the right questions, and ultimately make confident decisions about your savings strategy. So to wrap things up, if you're considering adding CDs to your savings mix, head over to The Balance's website. It's regularly updated with the latest rates. Do your research, compare options, and don't be afraid to reach out to financial institutions directly to get your questions answered.
And as you embark on your CD journey, here's one final thought to consider. How might your overall savings strategy shift over the next year, given what we've discussed about CD terms, interest rates, and the ever-changing economic landscape?
That's something to think about. And remember, everyone, happy saving. May your returns be high and your financial futures bright.
CDs offer higher rates than traditional savings accounts, but your funds are locked in for that chosen term. It's not really a break in case of emergency kind of investment.
Right, because early withdrawal comes with that penalty. So choosing the right term is important. Sounds like a balancing act, you know? You want to maximize your return, but you also want to keep some flexibility with your money.
Exactly, and that's where a strategy called CD laddering can really come in handy.
Okay, CD laddering.
It's a way to kind of stagger your CD maturities so you have access to a portion of your funds at regular intervals.
Yeah.
Every year or every few years. But you still get to take advantage of those potentially higher long-term rates.
Okay, CD laddering. That's come up a couple times now, I have to admit. I'm intrigued, but I'm still a little fuzzy on the details.
Sure.
Can you break that down for me? And for any of our listeners who might be wondering the same thing.
Of course. So let's say you have like $10,000 that you want to put into CDs. Instead of putting all of that into like a 5-year CD, you could divide it up.
Okay.
Put like $2,000 each into a 1-year, 2-year, 3-year, 4-year, and 5-year CD.
Oh, okay.
That's your ladder.
Gotcha.
And then each year, one of those CDs is going to mature.
Right.
And you can take that money, reinvest it in a new long-term CD. Or you can use it for something else.
So each year you have a chunk of money becoming available. That's pretty neat.
Yeah, it gives you options.
I like that. I can see how that would be appealing for someone who wants to play it a little safe, but still get those higher returns.
Exactly. It helps mitigate risk while still keeping your money working for you. And it's a strategy that can adapt as interest rates change. Let's say rates go up in a couple of years. When one of your shorter-term CDs matures, you can just reinvest that money at the new higher rate.
Oh, that makes a lot of sense. It's like you're building in some flexibility without sacrificing that potential for growth.
I like it.
Okay, so now what about those no penalty CDs we mentioned earlier? They almost sound too good to be true. Is there a catch?
Well, there is a trade-off. No penalty CDs usually have a slightly lower interest rate compared to traditional CDs. But the big advantage is you have the freedom to withdraw your funds without getting hit with that penalty. If something unexpected comes up and you need the money,
Right.
it's about finding that balance between return and accessibility.
Right. It's all about weighing those pros and cons based on your own personal situation. So we've covered CD basics, the different terms, some standout institutions from that balance report, and even strategies like laddering. But I'm kind of curious about what the balance might not be telling us directly. What are some of those other factors that might not be obvious at first glance, but are super important when you're actually choosing a CD?
That's a fantastic question.
Yeah.
I think one thing that often gets overlooked is the overall financial health and stability of the institution that's offering the CD. This is especially important when you're looking at those longer-term CDs, where your money's tied up for years.
Okay, so it's not just about finding the highest rate. We need to be thinking about the bigger picture. So how can we tell if an institution is actually as stable as they seem?
There are definitely some things you could look for, like check their financial ratings from those agencies like Moody's or Standard & Poor's. Those ratings can give you some insight into the institution's creditworthiness and stability. And you can also look into their history. See if they've had any recent regulatory issues or financial troubles.
Yeah.
And don't forget about customer reviews. Those can really tell you a lot about an institution's customer service and just their overall reputation.
Oh, that's a good point. So it's like doing your due diligence, almost like you're investigating before making an investment.
Right.
Makes sense. We're talking about our hard-earned money after all. Speaking of due diligence, is there anything else we should be thinking about?
Yeah, absolutely. Another thing people sometimes don't consider is how good the institution's online banking platform is and their customer service. You're going to be interacting with them for however long your CD term is. So it's kind of feel good. You want to feel comfortable and confident in their services.
That's a good point. I've definitely been frustrated by some pretty clunky online banking systems before. And if I'm locking my money away for 5 or 10 years, I want to know that I can easily access my account information and get help if I need it. Are there any red flags we should be looking for when it comes to online banking and customer service?
Oh yeah, for sure. Pay attention to things like website security, how user-friendly the platform is, and how available their customer support is. Look for reviews that mention response times, how helpful they were, and just the overall ease of interacting with the institution.
Okay, so we're building a pretty comprehensive checklist here. We got the APY, the term length, the institution's stability, their online banking, their customer service. But I feel like we're still missing one crucial piece of the puzzle.
You're right. We can't talk about investing without talking about the bigger economic picture. Inflation, interest rate trends. All of those play a huge role in the real return you'll see on your CD.
Right, we got to zoom out a little, look at the big picture. So how does the current economic climate actually factor into choosing the right CD?
Well, inflation is a big one. It can really eat away at your returns. Let's say you lock into a 5-year CD at 4% APY. Sounds good.
Yes, it's pretty solid.
But what if inflation averages like 3% over those 5 years? Yikes. Yeah, your real return after you factor in inflation, it's only 1%.
Oh, wow. That makes a big difference. It's a good reminder that those APY numbers don't always tell the whole story. So how do we actually account for inflation when we're making these decisions about CDs?
You got to be strategic. If you're expecting inflation to stay high, you might want to lean towards those shorter-term CDs. That way you can reinvest at higher rates later on. You could also look into inflation-protected CDs.
Inflation-protected CDs, what are those?
They adjust their interest rate based on inflation.
Oh, that's interesting. Is there a catch?
Usually they offer a lower base interest rate. Compared to traditional CDs, it's kind of trade-off. You get that potential for higher returns if inflation goes up. But you might end up with lower returns if it stays low.
Okay, so another thing to weigh the pros and cons on. So we've talked about inflation. What about interest rate trends?
Yeah, those are important too. Interest rates and CD rates are definitely connected. When the Fed raises interest rates, CD rates tend to follow. So if you think interest rates are going up, it might make sense to go for those shorter-term CDs so you can jump on those higher rates when your CDs mature.
So timing is key. Especially when interest rates are all over the place, it makes those short-term high-yield CDs like we talked about,
Oh,
the
yeah.
one from Ponce Bank Direct, seem pretty attractive. But then again, maybe you think rates have already peaked and you want to lock in a good rate for the long term with a longer CD. It's tough. Like you're trying to predict the future.
Exactly. And no one has a crystal ball, unfortunately.
Hmm.
But staying up to date on economic forecasts and trends can definitely help you make better decisions.
Yeah, okay, so at the end of the day, choosing the best CD for you, it's a pretty personal thing. There's no one right answer for everyone. It really comes down to your own financial goals, your risk tolerance, and how you think the economy is going to play out.
I couldn't have said it better myself. It's all about finding what fits your specific situation.
And that's why I think a resource like The Balance is so useful. It's a really good starting point. They do a great job curating those CD rates. But like we've talked about today, there are a lot of other things to think about beyond just the numbers.
For sure.
Hopefully this deep dive has given you the tools and knowledge you need to do your own research, ask the right questions, and make smart decisions about your savings. So to wrap things up, if you're thinking about adding CDs into your savings mix, head over to the Balance's website. They keep those rates updated. So check it out. Do some research. Compare your options. And don't be afraid to call up those financial institutions. Ask them whatever questions you have.
And as you start exploring the world of CDs, here's one last thing to think about. How might your overall saving strategy change in the next year? Especially after everything we've talked about today, CD terms, interest rates, and how the economy is always changing.
That's a good question. Definitely something to ponder. And hey, happy saving, everyone. May your returns be high and your financial futures bright.